The Fed tries to stop gold and silver rally, hence hikes may be back on the table. No hikes today, but the economic situation may warrant gradual rate hikes. Fed expects inflation to remain low. Single dissenting Fed member voted to raise rates. Translation: we aren't really raising rates, but we must halt the gold and silver rallies. Silver responds. Gold is also dropping upon the release. From the FOMC. Information received since the Federal Open Market Committee met in March indicates that labor market conditions have improved further, even as growth in economic activity appears to have slowed. Growth in household spending has moderated, although households' real income has risen at a solid state and consumer sentiment remains high. Since the beginning of the year, the housing sector has improved further, but business fixed investment and net exports have been soft. A range of recent indicators, including strong job gains, points to additional strengthening of the labor market. Inflation has continued to run below the committee's 2% longer run objective, partly reflecting earlier declines in energy prices and falling prices of non-energy imports. Market-based measures of inflation compensation remain low. Survey-based measures of longer-term inflation expectations are little changed on balance in recent months. Consistent with its statutory mandate, the committee seeks to foster maximum employment and price stability. The committee currently expects that with gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate pace and labor market indicators will continue to strengthen. Inflation is expected to remain low in the near term, but in part because of earlier declines in energy prices, but to rise to 2% over the medium term as the transitory effects of declines in energy prices dissipate and the labor market strengthens further. The committee continues to closely monitor inflation indicators and global economic and financial developments. Against this backdrop, the committee decided to maintain the target range for the federal funds rate at 1/4 to 1/2%. The stance of monetary policy remains accommodative, thereby supporting further improvements in labor market conditions and a return to 2% inflation. In determining the timing and size of future adjustments to the target range for the federal funds rate, the committee will assess realized and expected economic conditions relative to its objectives of maximum employment and 2% inflation. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial and international developments. In light of the current shortfall of inflation from 2%, the committee will carefully monitor actual and expected progress towards its inflation goal. The committee expects that economic conditions will evolve in a manner that will warrant only gradual increases in the federal funds rate. The federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. However, the actual path of the federal funds rate will depend on the economic outlook as informed by incoming data. The committee is maintaining its existing policy of reinvesting principal payments from its holdings of agency debt and agency mortgage-backed securities and agency mortgage-backed securities and rolling over of maturing treasury securities at auction, and it anticipates doing so until normalization of the level of the federal funds rate is well underway. This policy, by keeping the committee's holdings of longer-term securities at sizable levels, should help maintain accommodative financial conditions. Take care. Keep stacking.